Hello everyone, welcome back to the channel. Today I want to focus on what I think is one of the most interesting contradictions in global markets right now. The Federal Reserve sounds hawkish. Some Fed officials are still worried about inflation. According to the latest meeting minutes, some policymakers even supported a rate increase at the previous meeting, while several others argued that additional tightening could become necessary if inflation does not continue to fall. Normally, when I hear something like this, I would expect a fairly straightforward market reaction. I would expect Treasury yields to rise. I would expect the US dollar to strengthen. I would expect gold to come under pressure, and I would expect risk assets to become more cautious, but that is not what happened. Instead, long-term Treasury yields fell sharply. The US dollar weakened to its lowest level in roughly 3 months. Gold surged more than 4%. Bitcoin jumped around 7%, and the S&P 500 managed to recover and finish the session higher. So today, the question I want to answer is very simple. If the Fed is still hawkish, why are financial conditions appearing to move in the opposite direction? And more importantly, what is the market actually telling us? Before I continue, a quick reminder. Nothing in this video should be considered investment advice. I am discussing market dynamics, macroeconomic relationships, and technical levels for educational purposes. Every investor should make decisions according to their own risk profile. Let me start with the bond market, because I think that is where the real story begins. The US Treasury announced that it would significantly increase the size of its liquidity-supporting buyback operations for Treasury securities with maturities between 10 and 30 years. That might sound technical, but the market impact is important. After the announcement, the 30-year Treasury yield fell by around 10 basis points to approximately 5.18%. The 10-year Treasury yield declined by around 6 basis points to approximately 4.64%. These are meaningful moves, especially at a time when long-term borrowing costs had been trading close to multi-decade highs. And this development becomes even more important when I put it next to another number. US federal debt has now exceeded $40 trillion for the first time. That means the American government is operating with an enormous stock of debt while simultaneously facing very high long-term interest rates. This is why I think investors need to understand the distinction between monetary policy and Treasury market management. The Federal Reserve controls the policy rate and influences the overall stance of monetary policy. The Treasury, on the other hand, manages government financing. These are different institutions with different mandates, so I would not describe what happens simply as the Treasury replacing the Fed or openly reversing Fed policy. But I do think the market is asking a much more subtle question. Can Treasury operations reduce pressure in long-duration bonds even while the Fed maintains a relatively tight monetary stance? The market reaction suggests that, at least temporarily, investors believe the answer may be yes, and that matters because the long end of the yield curve affects almost everything. It influences mortgage rates, it affects corporate financing, it changes equity valuation models, it affects the relative attractiveness of gold, and it has a major impact on the dollar. So when the 10-year and 30-year yields fall, the effect can spread across multiple asset classes very quickly. That is exactly what we saw. Let us move to gold. Gold was one of the strongest assets of the session, rising approximately 4.3% to around $4,522 per ounce. I think the logic here is relatively clear. Lower Treasury yields reduce the opportunity cost of holding an asset like gold, which does not generate interest income. At the same time, the dollar weakened. And when yields fall while the dollar also weakens, gold often receives support from both directions. But I would be careful about simply saying yields fell, therefore gold must keep rising. The technical picture is much more interesting than that. Gold has recovered strongly after a major decline earlier in the year. On the daily chart, price has now returned to the area around the 200-day moving average, which is located close to $4,512. For me, this is a major technical decision point. The latest move carried gold into roughly 4,522, meaning price is testing or slightly exceeding that important long-term average. If gold can establish sustained closes above the 4,512 area, then I would start watching the 4,800 region as the next major technical zone. But there is also a risk. The daily SMI indicator is already above 80, which places momentum in an overbought area. That does not automatically mean gold has to fall. Overbought markets can remain overbought for a surprisingly long time, but it does tell me that after such a sharp move, chasing price becomes much less attractive from a risk management perspective. So I see the gold story in two layers. The macro environment has suddenly become more supportive because yields and the dollar have declined. But technically, gold is arriving at an important resistance area with elevated momentum. That combination creates opportunity, but it also creates risk. Now let us look at equities. The S&P 500 finished the session around 7,707.98, up approximately 0.2%. The Dow Jones also gained around 0.2%. The Nasdaq Composite rose slightly, although the Nasdaq 100 fell about 0.2% because of weakness in semiconductor stocks. What interests me here is not the size of the daily move. What interests me is the relationship between equity valuations and bond yields. When long-term yields fall, the discount rate used to value future corporate cash flows also falls. In very simple terms, lower yields can support higher equity valuations, especially for growth companies whose expected earnings are further into the future. That is why the bond market can influence stocks so quickly. But again, I would not describe the equity picture as completely risk-free. The S&P 500 daily trend remains strong. The index has recovered significantly from the sharp decline earlier in the year and has returned to record territory near 7,725. The moving averages are still constructively aligned. The 50-day moving average is around 7,541 and the 200-day moving average is around 7,102. That tells me the primary trend is still upward, but momentum is beginning to show a different message. The index has been making new highs, while the momentum indicator has not been confirming those highs with the same strength. That is a mild negative divergence. For me, this does not mean the bull market is over. It means I should become more selective. The market may still rise toward the psychological 8,000 level, but the probability of consolidation or a short-term correction becomes more relevant when price keeps making highs while momentum starts to weaken. This is exactly why I prefer scenario analysis instead of making absolute predictions. Now we need to bring the Fed back into the picture. The latest Fed minutes were clearly not dovish. Some officials supported a rate increase at the previous meeting. Several policymakers indicated that further tightening could become necessary if inflation fails to decline. That is important. The Fed is effectively telling markets that inflation risk has not disappeared. So if investors interpreted the Treasury announcement as the beginning of a permanent decline in yields, I think that would be premature. There are two forces operating at the same time. One force is the Fed, which is still concerned about inflation and does not want financial conditions to become excessively loose. The other force is the Treasury market itself, where the government needs to maintain liquidity and manage extremely large financing requirements. And this tension is taking place with federal debt above $40 trillion. That is why I think the long-term bond market will remain one of the most important markets to watch. If the 10-year yield continues falling from the current 4.64% area, that could provide additional support to gold, equities, and possibly other risk assets. If, however, inflation remains persistent and the market begins pricing additional Fed tightening, yields could quickly reverse upward, and that would change the entire picture again. The dollar is another important confirmation signal. Despite the hawkish Fed minutes, the dollar fell to a 3-month low. For me, that is significant. Markets do not trade only on what central banks say. They trade on the difference between expectations and reality. If investors had already priced in a hawkish Fed, then another hawkish message may not be enough to strengthen the dollar. Meanwhile, falling long-term yields can become the more important marginal factor. This is why I always tell investors to watch the market reaction to the news, not just the news itself. Sometimes the most important signal is not the headline, it is what the market refuses to do after the headline. A hawkish Fed normally supports the dollar, but the dollar weakened. That tells me another force was dominating price action. We can see the same dynamic in Bitcoin. Bitcoin rose approximately 7% to around $69,053. There was also a political element, with President Trump increasing pressure on Congress regarding cryptocurrency regulation. But from a broader macro perspective, falling yields and a weaker dollar can also improve the environment for speculative and liquidity sensitive assets. Again, I would not reduce Bitcoin's move to one single catalyst. Markets are rarely that simple. But when I see gold rising, Bitcoin rising, equities holding firm, the dollar weakening, and Treasury yields falling at the same time, I see a common macro factor running through several markets. That factor is the easing of long term financial pressure. The key question is whether that easing is sustainable. So let me build the two main scenarios I'm watching. In the first scenario, Treasury yields continue to decline. The 10-year yield remains below recent highs and gradually moves lower. The dollar remains under pressure. Gold holds above the 4,512 area and begins building acceptance above its 200-day moving average. In that environment, the next gold resistance around 4,800 becomes increasingly relevant. At the same time, lower yields could help the S&P 500 challenge the 7,725 area and potentially move toward 8,000. That would be the more constructive risk asset scenario, but I would still monitor momentum carefully because the S&P 500 is already showing some signs of short-term exhaustion. The second scenario is more defensive. Inflation remains sticky. The Fed becomes even more explicit about further tightening. The bond market begins to question whether the Treasury's liquidity operations can meaningfully offset inflation and supply concerns. The 10-year and 30-year yields begin climbing again. The dollar rebounds. In that environment, gold could fail to establish itself above 4,512 and move back toward 4,331. A deeper correction could eventually bring the 4,164 area into focus. For equities, I would watch the 7,541 area on the S&P 500, which corresponds roughly to the 50-day moving average. A sustained break below that region would be much more important to me than a small daily decline from record highs. This is why I do not think today's market can be summarized with a sentence like, "The Fed is hawkish, therefore markets must fall." That is too simplistic. Financial markets are an ecosystem. The Fed matters. Treasury issuance matters. Bond liquidity matters. Government debt matters. Inflation expectations matter. The dollar matters. And all of these variables interact with each other. Right now, the most important message I am receiving from markets is that long-term yields have become a central transmission mechanism across asset classes. When those yields dropped, gold exploded higher, the dollar weakened, equities stabilized, and Bitcoin rallied. That is not a coincidence. But I also do not assume that one session defines the next 6 months. I want confirmation. For gold, I want to see whether 4,512 becomes support rather than resistance. For the S&P 500, I want to see whether the index can hold its major moving averages while momentum stabilizes. For the dollar, I want to see whether the 3-month low develops into a genuine downtrend. And above everything else, I'm watching the 10-year Treasury yield. Because in my view, that is where many of these stories currently meet. If long-term yields continue falling despite a hawkish Fed, the market may be telling us that liquidity management and financing dynamics are becoming as important as the policy rate itself. If yields reverse sharply higher, then the Fed's inflation message may quickly return to the center of the market. So I am not trying to guess which headline will dominate tomorrow. I am watching the relationships, Fed versus yields versus the dollar versus gold, yields versus equity valuations, and liquidity versus risk appetite. That is where I think the real information is. My approach here is simple. I do not chase a 4% move in gold just because the macro story suddenly looks attractive. I do not assume stocks can only rise because yields fell for one session, and I do not ignore a hawkish Fed simply because markets initially reacted positively. I wait for levels to confirm the narrative, because in markets the story can change very quickly. Price usually tells me when that change is becoming real. And right now, the most important market to watch may not be gold, Bitcoin, or even the S&P 500. It may be the US Treasury market. Because if the direction of long-term yields changes, the direction of almost everything else can change with it. Thank you for watching. If you find this type of macro and technical analysis useful, you can subscribe to the channel and follow the upcoming videos. I will continue focusing not on dramatic predictions, but on the levels, relationships, and scenarios that help me understand what the market is actually pricing. See you in the next video. This content is for informational and educational purposes only and does not constitute investment advice.